Welcome to another 21 Hats Dashboard. I'm Lauren Feldman, and I'm here with Michael Brown, who is co-founder and CEO of Teamshares, which has embarked on several worthy causes, including helping aging business owners sell their businesses and also spreading the adoption of employee ownership. Welcome back to the podcast, Michael.
Thanks for having me back, Lauren. It's hard to believe it's been 3 years.
It is hard to believe. I appreciate you taking the time. Michael, you first joined us back then. At that point, Teamshares had already bought more than 60 businesses, I believe, in 40 industries, with most of those businesses purchased having annual revenue between $1 million and $5 million. Can you bring us up to date? Where do you stand now?
Yeah. So at the end of 2025, we had 90 companies. And our total operating profit from all the companies is about 60 million, on a trailing 12-month basis. And I would say we've widened our size criteria. When we started off, I think 1 to 5 million of revenue, which would have been sort of 200,000 to maybe up to maybe just scratching the surface of 1 million of operating profit. As we got further along and our financing capabilities expanded and had a more diversified company, we were able to, we actually originally had owners come to us. We actually had someone get on an airplane and show up at our office. And so we've actually, continued to do sort of true small businesses, but add sort of like businesses that are a touch larger than that too, that have also wanted the same model. So kind of right up to, 5 million or so of operating profit.
I think you said the total profit for all the businesses is around 60 million. Can you tell us what the revenues are for the group?
Yeah, it's about 450 million of revenue and sort of 60 million of operating profit. I would guess back then if we were at, 60 companies in, we might have been, sort of 30-ish, maybe 25 to 30 million of operating profit sort of back then. But I'm just going from memory.
Got it. So now the big news for you is you're going public, which seems kind of counterintuitive for a company that promotes employee ownership. Can you tell us what you're doing and why?
Sure. So we may not have touched on it in our last podcast, but it's been the plan from day one to go public. And I can talk about it's the reason why we raised venture capital, right? So we raised venture capital to try and build the biggest company we could in order to address as many companies as possible that are facing succession and, help bring employees into stock ownership as well. So that was a very deliberate decision. The alternative way at least the typical alternative way for someone to go and, buy businesses at least would be to go and raise a private equity fund. And that for us wasn't sort of the model that we thought made a lot of sense for a lot of reasons. We thought that a holding company that's publicly traded would be the best chance to continue to help expand our model to as many companies as possible, because public companies have much greater access to capital than private companies do. So if the goal is to help both from a shareholder standpoint and from a social mission standpoint to help as many companies come into our model as possible, being public helps us maximize the odds of doing that. And it's been the plan since day one.
I'm curious, you mentioned that you started by raising venture capital. The typical business model for private equity in buying businesses, rolling up businesses, sort of along the lines of what you do, is to buy and then with the plan to flip them in 5 or 7 years or whatever they choose. Mm-hmm. You have made the promise when you buy these businesses to keep them, to not sell them, to convert them to employee ownership and hold on to them. How were you able to get venture capitalists to back you, given that you weren't going to have that automatic payday when you flip the businesses?
Yeah, so there's two really great and important questions within your question. One is about sort of venture capital and how do venture capital, investors sort of make a return in Teamshares, and why did they back us? The other is sort of, how do you sort of make returns in acquiring a company, right? And what's the best way? So on the first part, this is because our business involves acquiring a business. people tend to think, oh, it's a fund. Well, so how is, like Union Square Ventures or Coastal Ventures, how are they going to get paid back? Well, the investment, bet that they made alongside sort of management team is that we have an opportunity to build a large and enduring public company that has the opportunity, because of a large company with a novel solution, with a team that has a real passion, a real edge for what they're doing, and can continue for decades to build a really large company. So there was never any sort of fund. It was just, hey, you're investing in a private company, hoping that it can become a large public company, and that's really the sort of the core use case for venture capital. And because the portfolio effect of venture capital, it allows those types of investors to take a lot of risk on novel ideas. So they were with us from the beginning. And then in terms of so because of that, when we go public, those shareholders, that'll be sort of permanent capital. So those investors, there'll be some who, made an early stage investment, and they will then sort of, pass their shares through to their investors or sell their shares. And there'll be others that will, continue to hold stock for, a decade or more. But now we don't need to provide a return. Other investors can come and buy their shares from them. And that's one of the great beauties of going public. Um, from the management team and for many of our investors, it's not an exit. This is just sort of the next phase of building the company and scaling our mission. And then in terms of the sort of like the, I guess, internal return for us, because we're an operating company, we're a corporation, these are all sort of internal returns and internal cash flow that's reinvested in, acquiring more companies to start the employee ownership journey. We absolutely measure how companies are performing. We're not a fund. We don't buy and sell. And why don't we do that? We always try and have, Lauren, a capitalist. We're a positive sum business. We're very much a for-profit business, right? That is a capitalist business, but we believe in multi-stakeholder capitalism. We believe in positive sum thinking. We try and always make sure that we have the reasons that we do things line up with shareholder values and our own, sort of business values, right, for all our stakeholders. And for us, it's very simple. Like, we just actually don't think that private equity is a good way to invest. It may have been 30 or 40 years ago, but actually the returns of private equity are not very good. And that is with all the due respect to how much work goes into sort of building companies and raising capital and stuff, but the returns are just not very good. And if you buy a business for 5 times and sell it a few years later for 6 or 7 times, well, that's great, but what do you do next? Whereas if you're a business owner, people should just relate to being a business owner. You sell a business when you're 60 or 65 or 70, because every year you own it, you get another year of cash flow. So if you have a 20 or 100 year ownership view with a company, you have 20 or 100 years of cash flow, not a sort of quick return. And then that's the sort of shareholder and capitalist side of it. And then on the company side of it, I think that private equity, we try and always just be neutral about everything. We're neither for private equity nor against it. We just think it's just a thing that is, and it and it exists. But I think that the reputation of private equity is often far behind the current reality. So I mean, private equity in the early days there was a lot of slash and burn. I think that private equity for many decades now has been actually more focused on growth. I actually think the issue, from a company perspective, business owner perspective with private equity, is twofold. One, it's quite likely the company will be for sale multiple times, right? And that's not a healthy thing for a company to just always be for sale.
Sure.
And two, the reason why private equity firms are often able to pay a much higher price than sort of Teamshares would, is that oftentimes part of the investment case is to reduce overhead costs by dismissing sort of part of the management team, or the at least more of the middle management team, and that's not our model at all. And so those are all sort of personal decisions, and people should be allowed to do with their business whatever they please. But for us, I think mostly because it is the business is always for sale or perpetually for sale 2 or 3 or 4 times. And, look, there's real pressure to cut costs. Those are just outcomes that not every business owner wants.
So everything you just said makes a lot of sense to me. I'm curious, how hard was it for you to find investors who believe that?
So I think that a lot of investors sort of believe, well, you fall into one of two camps. Okay, so I do think that there are, I think it's like, what's the phrase, like received wisdom. I think it's received wisdom that the private equity model is like, that's how you make money, right? And like this is it, but actually the data shows that it doesn't. And actually, the data shows that holding companies ranging from Berkshire Hathaway to Constellation Software to like Roper back in the day, or publicly traded companies in Europe like Lifco, they actually provide far greater shareholder returns than owning a business for 2 to 4 or 5 years. So you either know that data or you don't. I think that's probably the way like just among investors. You either know that holding companies are better shareholder returns than private equity, or you don't. And if you don't know that, I can't really help you. You're going to need to just sort of study the data and check your assumptions. And this is partly why Teamshares is a contrarian company. I think amongst investors who do understand that, of which there are a number, because obviously Berkshire Hathaway is really famous, which is probably not everyone knows all the other companies that are sort of Berkshire-like in a different model, right?
Sure.
I think the debate on that I think investments into a company, whether public or private, can always be framed into almost like debates about like the risks of the company and are they going to achieve X, Y, Z. I don't think that was sort of ever really like a debate about Teamshares. It was more like, how big can you get? How long is it going to take? Like, will the employees stay? Those types of things. If you thought about it as like a decision tree, yeah. Do you believe private equity is the optimal model or not, or holding companies? And then, if you believe holding companies are a great model, it was really more of a bet on, execution and time and things like that.
So let's talk about what you do. I kind of think of Teamshares as something of a big experiment, both in terms of understanding how you help business owners exit, sell their business, and how you help employees get a stake in the outcome. Lots of people are doing this at small scale. You're doing it at a very large scale. And I presume learning a lot of things that a lot of business owners would love to know. For example, you train managers to take over these companies. You bring in presidents to run them. Has your thinking about what constitutes good management of a small business evolved at all?
Yeah, I mean, first of all, so I receive the word experiment with like great delight. I think it's like a huge compliment, and I think that it speaks to creating something novel, and also speaks to sort of the startup ethos of always being able to continue to innovate and run sort of experiments within your model, right, to keep tweaking things. I do think hopefully we're now at a stage, sort of number of companies and size of financial footprint that I think we've shown that the experiment is paying off and that the market is really receiving what we're doing well, both on the business owner side and on the employee side and on the shareholder side. But that said, so what have we learned within that? I think we've done a really good job retaining key employees. Right, that's the first thing. That when we underwrite a company, we just are not able to acquire a company. We can't provide what we provide to the true sort of Main Street business that is sort of spouses into employees. That just is too owner dependent. For us, we need something that is 20, 30, 40, 50 employees, sometimes even 100, depends on the size of the company. But there are generally 5 key employees, ranging from a general manager to a bookkeeper to a parts manager. It just depends on the business model. And we've retained about 90% of those people. Of the 10% that leave, usually about half is sort of voluntary attrition, that maybe it was a son or daughter that sort of decided they want to transition out. The others that say the leadership team of that company determine after a couple of years it may not be the right fit. So I think that we've learned that really assessing the team, it is a core part of what we do. Both on the business and the capital side and the social mission side, is that making sure that we're providing durability to the business and opportunity. I think that we tend to, about 4 in 5 companies, we need to hire an external president, someone who can be the president role. To us means the ultimate leader who is financially accountable for the financial performance of that company. Before that, it was the founder owner, right?
Yep.
And so, we nearly always are able to retain for many, many years the sort of general manager or the VP of operations, the so-called right hand. But they're already busy with a full-time job. And two, they may not have had P&L responsibility before, which is a big thing. I mean, I even think of myself taking that on, knowing I was going to do it. And so we find that it's sort of a bridge is often needed, or bringing in an external presence. And I think the biggest thing we've learned, which is just so obvious in hindsight, but was a miss of projection, is that industry experience is really what you want. And I think because the founders, because we were total outsiders and generalists, and we sort of figured it out, how to run small businesses through very humbling experiences, by the way, like lots of trial and error and mistakes. We came into it with this perspective that like, oh, well, like, yeah, if you bring in people from McKinsey, right, that's a scalable template. Right? And it turns out that in some businesses that can be a great answer, especially if that person, not only worked at, say, McKinsey, but like they also were an engineer and were in the military and they worked at Caterpillar, right? That's a very different profile than, like I was, right? Sort of coming out of investment banking and never managed anyone. I think that industry experience is just it's so funny because early on we tried hiring from industry and it didn't go that well. And I think over time we just sort of realized that like, oh, we're not picking the right people. And I think that was very key. I think the other thing too is that I think in the early days we talked only about when we showed up at the companies, we would talk only about employee ownership and how great it was. And we didn't talk enough about sort of how Teamshares as a business makes money, and that that it's a for-profit business. I think trust went up as we were able to explain the whole picture.
I think you're probably not the only ones who've learned that lesson. I'm always intrigued in talking to people about the searcher model, which I'm guessing you're probably familiar with.
As in search funds?
Yes.
Yes.
Where, the theory is you get a bunch of smart MBAs who have been taught how to run a business and know all the software tools and can come in and take over any kind of blue collar business, in particular, a home services business and run it better than someone who actually knows how to change toilets or,
sure.
mow the lawn or whatever.
The founder of the business. Yeah.
Right. And I think that's a really interesting debate because obviously there are advantages to both. It sounds like you've learned that lesson as well.
Yeah. I think that, so it's actually like, even if you take it up a level, it's because you have this debate in startups too, of like generalists versus specialists. The answer, like all things, the answer is always great. You want both. Like, it is the same thing with AI. Like, oh, AI is going to do everything. No, it's going to be AI plus a human, right? That's my own opinion. But so I think that is very true, and that's how we sort of think about sort of matching, presence in our model. In terms of the search fund model, look, I think that a search fund is quite different than what we do. It's analogous, of course, because hey, it's going and you are acquiring a small business or a small to mid-sized enterprise from often a retiring owner. Their difference is that they are building it's a single LBO, typically. Some people do it in a different way, but the typical model is you search for 2 years, you find something, or 2/3 of people find something, and then they raise the capital, and then they close it. And those are a bunch of steps to get through, and then you've got to operate it. And the goal is to sell the company within 3 to 5 years. So you can think of it as like a single LBO, a single leverage buyout, a single private equity deal. As for the sort of leadership piece, look, I think it can work. I think it comes down to the person, right? I think the thing is that no matter the business model, whether it's ours or a search fund or anything in between, at the end of the day, running a small business, it's a gritty job, right? And it's not a strategy job. And I think that was part of our mistake in hiring generalists early on. By the way, we never described it as a strategy job. I think that people thought it was going to be a strategy job, and we try and even explain in my job, like strategy is like 2% of my job, right? The rest of it is all execution. And so I think that is, whether you're a search fund, whether you're starting a business, whether you're inheriting a business, whether you're a president in a Teamshares model, I think at the end of the day, or you're an employee getting hired into a small business, I think that it is all about execution. And that's very different than knowledge work, where ideas are the execution rather than, let's say, invoicing is the execution.
Right. You said you've learned a lot through trial and error. What percentage of the businesses you've bought have failed?
Very few. I think our failure rate is something like 1.5% per year. So it's very rare, and most of them were sort of like really early acquisitions that were really small in two particular industries. It was either sort of in the contracting space, sort of construction, or really small restaurants. We're talking 1 million of revenue, 2 million of revenue. We had an idea to try and buy a couple of restaurants in a particular geographic market, and then run them as a combined company. I think there was a combination of, we didn't have the industry hiring model down yet. It was a weird time, right? 22 to 23 to 24, the inflation situation was real. I mean, for some small business, cost was far in excess of the headline 8% inflation. Um, and then I think that those businesses, both the industry and the size of those companies, you're talking 1, 2, 3 million of revenue, there is just much more key person risk in transitioning the business. Like, are you going to be able to keep doing the same amount of revenue and profit that the owner did? And at that size, because the owner is there's a reason your podcast is called 21 Hats. In all seriousness, I mean, financially, the founders of those businesses, they are doing multiple jobs, right? They're doing 2 or 3 people's jobs to replace them. And so those were, it was extraordinarily painful. There were a few businesses that we did have to shut down. There were a few we were able to convince the former owners to take them back over. But we learned from those mistakes, and moved on to try and make sure that we picked companies that worked really well in our model going forward.
That's a remarkably low percentage of businesses to fail.
We're very proud of it, but it's very. I mean, I can tell you, like, those were somber discussions. We tried in those cases for in some cases 2 years to try and get the companies, and for those ones that didn't work out, there were another there was sort of like 2 or 3 times that in businesses that went through a tough period, and we were able to turn them around. Yes, it is compared to any stats around starting businesses, acquiring businesses, it is a remarkably low number.
You just mentioned that you kept trying, and in some cases for years. Do you think there were occasions when you tried too hard and too long because of the employee ownership aspect?
Yes, but also the shareholder aspect too, right? So I don't actually could say actually it was so let me just give you the shareholder side of it first. Okay.
Sure.
Because again, it's always trying to, but we don't think that they are like zero. We don't think that they're like competing interests in the same way that Amazon figured out that, like, hey, if you treat consumers really well, in the long run, shareholder interests are served too, right? And it's a controversial idea. Our application is totally different, but I'm just saying it's a contrarian idea. And so I think that if you acquire a business, right, and let's say it has $1 of profits, right, and the profits go to zero, okay, well, that's unfortunate for everyone. But if the profits can get back to $1, right, and you have a multi-decade sort of ownership period, you are far better off getting the company sort of back to profitability, right, than to sort of shut it down, because you have a multi-decade period of profitability, and you risked capital to take on that business and start the sort of journey for that company, right? And then I think on the employee ownership side, I think that when you have a company that's both a good steward of capital but also takes a really long-term perspective, I think that it creates trust, and there's like alignment in that our model. The way that employee ownership happens is through profit, is through cash flow. So everyone's aligned. So no, I don't think that employee ownership on its own was a cause. I think it was us being like really long-term minded. I do think there were some cases where that was too long, because a little bit like, the first time in your career, if you have to let someone go, you may wait too long.
Sure.
Um, for us, I think now it, first of all, just almost never happens. It's very rare. Like, I don't think it's happened in a couple of years. And two, we have so much more data in the companies. We now have weekly operating KPIs, and we have people who are directly responsible for making sure that the companies are thriving. And if we see something slipping, even in a couple of weeks, we're able to react, and not react is the wrong word, almost like get ahead of it before we see any issues coming. And I would say 3 years ago, none of that software was built, and we were really seeing the business, with us almost like a 90-day lag in terms of financial reporting.
So, what do you think is the most important reason that explains that low failure rate? Is it the professionalization of the operation that you were just describing? Is it employee ownership? Are you skimming the cream off the top? Are you just buying profitable businesses that are much less likely to fail?
Look, I think it's one of those things. I remember someone using the phrase over determination, where there's 7 or 8 or 9 reasons, and it's like it's yes to all of that and like another 7 reasons, right? So I think first of all, all of the people at Teamshares really, really care, right? Like, and again, we've constructed in the way that this is a mission oriented for-profit company. And there are people who come and leave other opportunities to come spend time working on this company and scaling this, as you called it, kind of grand experiment, right? So I think everyone really cares. Everyone's in it for the long term. Everyone cares about sustainable profitability, treating people well, relationships, all of that stuff. I do think that we have a fiduciary duty to pick low risk businesses that can transition really well. And there are businesses that would be great if like you and I bought individually, right, to only work on that. And there are businesses that just don't work in the Teamshares model, right? I'll give you an example. We came across a call center business, and they had part of their operations offshore. And, it was interesting because they were able to pay the people in the offshore market well above market and then charge their customers a lot less. So kind of everyone was winning. Operationally, very hard for Teamshares to be involved in a call center business in a developing market. It's just really, really, really hard. And so that business was actually a great business. It was just sort of more operationally be super challenging. And so I think that we do focus on businesses where, because the mistakes we've made early on were the businesses that had too much kind of key person transition risk, we are picking businesses that are, durable. But we're also coming to terms that are our market. We're not going to be able to sort of pay the types of multiples that a private equity firm or roll up would. And I think that it's the whole platform together of buying good businesses, hiring great leaders, retaining all the key employees, having people learn about stock and profitability, see the numbers in our software, and just having a lot of trust, right? And so, like there's some, this is like very off media training to bring up, but the vast majority of people are really happy because they get to keep their job. There's no cut in pay or benefits. They have an opportunity to earn stock. And sure, a bottom third of folks who are more temporary, they're never going to care about employee ownership. But the long-term employees now have a real opportunity to know that company is in a permanent sort of joint state of ownership with us and the employees, and an opportunity to participate in the value and the profits of the company.
You mentioned the period from, I think, 22 to 24 being an unusual period, especially with inflation. 25 was an unusual period, too, for all sorts of reasons. Yeah. And I don't think I've seen another year like it, where there was so much uncertainty and so much confusion as to whether the economy was good, bad, indifferent. I mean, people just to this day can't completely agree on it. And, I can find people who tell you that small businesses did just fine, and others who tell you that small businesses were devastated. What's your view of that? You see a lot more small businesses
25.
than most people. Yeah, just 25.
Yeah.
Was it a good, bad, terrible year for small businesses large and your businesses in particular?
Yeah. So thankfully for Teamshares, 2025 was a really good year. It was a record year, both in terms of acquisitions, and that we acquired 25 million of sort of new EBITDA from new companies, but also the profits of the existing companies grew sort of organically, meaning sort of like, the companies that were owned the year before, all of them grew sort of a mid-teens profit growth rate, which is, helps everyone win, right? So internally, thankfully, the data was really, really strong for Teamshares. The outside perception, the amount of certainty, the amount of times the recession debate came up again was insane, and justifiably so. You want to call Teamshares an experiment? I think there have been a few policy experiments that have been run, from the spring onwards, and it created a lot of uncertainty, and to the point where financing sort of dried up overnight, because whenever at the bank level, the sort of institutional level, like, AI is its own thing and it's totally decoupled from, sort of most macro economic stuff. So that sort of kept plowing ahead. But it was just sort of pencils down for a lot of, sort of any sort of financing. And then just for companies themselves, of course, it has a knock-on effect of like great uncertainty for hiring and capital spending. And, then of course, there's companies that, are directly exposed by some of the policy changes that have been made.
Do you have any manufacturing companies?
We do have manufacturing companies, but our companies are all onshore. So I think literally 100% of our revenue is, and then very little. I mean, obviously there's an indirect exposure that people do buy things internationally, but.
Well, not just that, but people, even domestic manufacturers, saw their expenses go up because of the raw materials that were tariffed. Did you have an answer to that problem?
Yeah, I mean, I think the unfortunate answer is that tariffs have to be paid by someone, and it usually has to be paid, at least in part, by the consumer, right? And so tariffs raise prices. Like that's just sort of like from the economics textbook. Now, most of our sort of like input costs across Teamshares, I think, it just really is domestic sourcing all the way through. So there's very little exposure to imported parts and stuff. There's some indirect exposure, but it's very, very, very small. And so, we knew which companies. There's a small handful of companies that had a little bit of, importing of raw materials, and we were able to manage it by balancing, sort of, price adjustments where needed. But we focus on really simple businesses that don't have cross-border complications, and that goes like back to the beginning. I think we just want to have really simple to understand, simple to operate businesses that are durable and full of great people and reliably produce cash flow.
Has AI had an impact on those simple businesses? Have you found ways to implement it to help them?
So we've been using AI and building it into our software at the Teamshares level, for years, right? To help sort of like automate more tasks, ranging from accounting to even the analysis up front. We're now starting to run certain implementations at some of the companies. We're sort of testing, which places is it going to be most useful, and then try and get adoption across the company again to help make running a business easier. What's really interesting with the small business AI debate is that, and this is someone like I'm an hourly active user of ChatGPT. Like I'm not an AI skeptic. I love AI. I just think, like with all new technologies, you get these maximalists that say it's going to solve every problem under the sun, and that's ludicrous, right? But AI is really fascinating to me, and we use a lot. But what's really interesting, Oren, is the narrative in small business is like, I think it's hilarious. I mean, people make these comments. People have raised in huge sums of money making statements like AI is going to take all the cost out of running a small business. Well, anyone who's ever made human contact with a small business knows that they are 100% owner S corps run by incredibly frugal people. There's no cost to take out. Now, what it can do is I think it can allow you to scale with fewer people. I think it allows a customer service rep to handle 2 or 3 times the revenue that he or she might have been able to do before. I think it allows you to complete certain tasks much faster, right, and with greater accuracy. But I just think that the premise of like having costs to take out in a small business, and we're talking about like, 10, 20, 30, 40. It's different if JP Morgan says, hey, yes, we have 100,000 employees, there's cost, there's people, or jobs are going to be limited. That's not, I don't think that's really feasible, at least in the short term. And in our case, it's not within our values. We do not come in to cut people. We come in to buy the business the way it is, and try and help it continue to evolve and strengthen.
Do you think your business model would work if you were not converting the employees to employee owners?
Sure, I think you could. I think you could absolutely, because I think that experiment has been run before. It's called Berkshire Hathaway, right? So yeah, absolutely, you could. We think that now I don't know that people's success rate would be as high because one, like when you acquire a small business, right, it's generally all people driven. It's not like you're buying, sort of, at least we're not sort of buying companies that we don't think they generally exist, or businesses with 10-year contracts. And you're buying businesses that are heavily dependent on people, and retaining and motivating them and giving them an opportunity is very key to the success of the profits of the business. Again, this is why we don't think that sort of employee equity and shareholder equity are like as long as you do it in a thoughtful and profitable way. I don't think that they are sort of really at odds with each other. So yes, of course, you could acquire small businesses without employee ownership. We think that our model is superior both for employees and for shareholders, and we think that it's a really important thing to exist in the world. And because it is contrarian, it's just not what most people are trying to do, and it allows us to do things differently and have a differentiated offering. And a part of our differentiation too is that for a retiring business owner, you don't have to go through all of this yourself. You just can sell the business when you're ready to retire, and retire in 3 to 6 months. Some people stay a year, it depends on the situation, but you just get to sell the business and work towards retirement. It's not like a 10 or 20 year journey for you.
What do your employee owners actually get in terms of ownership? Do they get a percentage of profits each year? Do they get a piece of equity when they sell, when they leave or retire? Do they have a say in how the company is managed?
Yeah, so we probably talked about this in the last podcast, but to recap, yeah, there's we show up and do a 10% restricted stock grant that people earn through service over 4 years, and then the rest of it is based on how how the business performs, with a path to majority employee ownership over a couple of decades. So it's sort of the same ownership period that I guess sort of a founding owner would typically own a business for. And so most of the value in stock ownership is from the appreciation of shares, and it's really meant to reward the people that stay the longest. Now, everyone participates, or in most cases, in the smaller employee bases, sort of everyone participates. Sometimes when you get into retail concepts with 200 employees and seasonal workers, it's sort of only sort of like really long-term employees. But so most of the participation is through long-term, appreciation of the stock from staying and profit performance. There are dividends, and those, become meaningful over time. But for now, early on, it is really about the long-term value of the stock.
In talking to business owners who are considering some form of employee ownership, an issue that often comes up is the employees don't always welcome employee ownership as the owner articulates it. Their immediate response is often, that's a retirement plan. I need the money now. Do you face that at all?
Look, it's a totally fair question. We're not a retirement plan, right? And so both things are true. That I completely understand if someone is at towards the end of their career, but like we are not a retirement plan, right? We're a way for people to earn stock through through staying. And so I think that sort of setup is really kind of between the former owner and sort of their decisions. But it really the value is for the people who are going to stay and kind of build the company over the next sort of 20 years with us.
Do you think they really feel like owners?
It depends. I mean, the stat is, so again, there's a top third, and I'm saying in terms of like how much they value employee ownership. There's kind of always a top third that really, really value it, both financially and emotionally, culturally. There's generally a middle third that is like neutral, and maybe they start off skeptical, but become like, okay, I'm getting a dividend, and they said what they're going to do, and within 6 to 18 months, people are feeling pretty good. And then there's a bottom third of people who really don't care about it at all, either because mostly because actually they're probably just going to be a short-term employee with the company. Could be seasonal, could be only a year or two, and that's not what employee ownership or any, including like partnerships like Price Waterhouse, like you create stock wealth by staying there for 2 decades, right, or 3 decades. So we're okay with that. That's natural. That's human nature. But I think that you want to have a majority of the people be supportive.
Do your employees assume any risk if the business were to fail?
No. And that's a key differentiation. And when people say, well, why does it take 20 years? They're like, well, we're taking every dollar of the risk. Right, like there's an SBA market out there for people to go and save up and take on a personal guarantee and take on debt service and cut their salary, and that market's out there for people to go take advantage of. We wanted to provide an opportunity that was, again, positive because the reality is that in small businesses, the profitability levels is like a percentage of revenue. They pale in comparison to professional services or software, everything. And so like the pay in these small businesses is middle income pay or lower middle income pay. So how could you sort of have the ability to generally take serious financial risk in taking it? So we wanted to create a way for people to earn it in an aligned way as the company itself produces profits and people stay for the long term.
Do you do something to segregate or protect the money that your businesses will need to pay out employees who retire or leave? Is that money protected in some way against the failure of the business?
No, we're not a retirement benefit plan. So we're not. We're not a retirement benefit plan.
But when somebody retires, they do get to sell their shares, right?
Correct.
So it kind of works the same way, but you're saying it's
the cash flows of the business are able to repurchase that stock. But no, we don't, and we don't. This will show up in our financial statements as a public company, but we don't carry a liability for the stock program.
So what would happen if somebody worked at a business for 19 years and it failed? Would corporate Teamshares step in to protect those employees?
We haven't come across that scenario of owning a business for 19 years and it failing. And so I think if that were to happen, we would make the right decision at the time, balancing shareholder interests and employee interests.
I see. How many employees does Teamshares have?
At the parent company, it's about 85 people, and then I think if you consider all the companies, all the subsidiaries, it's well over 2,000.
At the parent level, is there some form of employee ownership there for those employees?
Yeah, absolutely. Every employee at Teamshares Inc. has stock options in Teamshares Inc.
How does it work for a public company to make the promise to never sell the business that it requires? Is that as firm a commitment going forward, knowing that the shares can be publicly owned?
Yeah, I mean, again, it all comes back to having a business model premised on things that are good for shareholders and good for companies and employees. And so again, it comes back to this. There's this received wisdom that it's better investing and better sort of returns to buy and sell a company quickly. Publicly traded companies are worth much more than private companies. And so it would be not in our interests or the local company and employee interests to sell a company. We just think it is much better off in the system than trying to sell it to a competitor or to to a private, so it is, or to a competitor, just PE firm, it would just not be valued as highly as a consolidated public company. So I think it's well within shareholder interests for the permanent ownership model. And then again, it's a highly differentiated promise that others can't or won't make. And that's a promise we can make to retiring owners, that we will not sell your business for a profit.
We're just about out of time here. A couple of quick questions I just wanted to nail down. How do you find the businesses that you buy?
We get over 70,000 listings of businesses every year, of businesses that are actively for sale from business brokers and M&A advisors. And those listings are gathered into our software, and we start the process of moving each acquisition through our underwriting process, and we'll end up of those 70,000, about 13,000 are kind of size qualified, and we end up doing real work on about 3,000 companies per year. So we're able to find companies that we think fit our model well.
Sounds like a job for AI.
Yeah, look, there is meaningful. I mean, like, there's tons of human decision, and as there should be. It's a very important job, both again on the shareholder side and on the human side of the business. But yeah, it saves a lot of steps, and we've been building it in for years. So.
I asked you this question last time 3 years ago, whether you saw a way that you might be able to help the business owner, and there are far too many of them, who's too much a part of the day-to-day business to actually sell their business. Yeah. There are a lot of those businesses right now, especially with the baby boomers aging out. Have you gotten closer to figuring that problem out?
Okay, so Teamshares, the company, I don't think that's going to be in scope for us to solve that problem. Certainly not to solve that problem. I can give, maybe in the long distant future, we can, help create tools and things like that. But we have a really, focused sort of plan ahead of us we need to execute on. Now, in terms of just like my sort of personal opinion as a business person, sort of what a business owner should think about, it's probably the same answer I said last time. They should read and implement Traction or some other system like that is a management system that helps people build the processes, the team, the responsibilities, so that the business is not owner dependent. And I think the reason why I always recommend Traction is there's a bunch of them out there. And I don't want to name the other ones because any of them work. Whichever one gravitates to. The reason why I always recommend Traction, or EOS, Traction's the book, and EOS is the name of the entrepreneurial operating system. It's fairly complete, and it's fairly simple. A lot of the other ones can get really hung up in just they're overly analytical and everything. Like, it is just a very simple playbook. When you read the book, and then you have a decision making, you want to try an implementer, do you want to pay an implementer to come in? I think it's better to bring an implementer in. We have no financial relationship with EOS, just to be very clear. I just think that's how I figured out how to run a business. And I think that it works for all businesses, whether it's 5 employees or 50. So.
Michael Brown, I kept you longer than I promised. I apologize.
No worries.
I could probably talk to you all day. I find this all fascinating. I really appreciate what you're doing, and you're coming here and sharing it with us.
Of course. Thanks for having us on, and look forward to keeping in touch.
Michael Brown is co-founder and CEO of Teamshares. You can learn more about Teamshares at teamshares.com. Thank you, Michael.
Thanks. Bye-bye.